All right, guys. Welcome to ACCA classes of MEPL. Myself, CA Dinesh Vadera. Uh, I'm a qualified chartered accountant and a commerce graduate. Uh, been into the teaching profession for more than 10 years now. In ACCA, my core competency subject is Advanced Financial Management (AFM). and before we start our lectures formally, uh, let me introduce you to the MEPL classes first. So, to know more about MEPL classes, you guys are expected to visit the MEPL official website, which is www.meplclasses.com. On the landing page or home page, you will first get to see the glorious result of MEPL classes. MEPL has been conducting classes for professional courses like Chartered Accountancy, Company Secretary, ACCA, and CFA. Uh, Below that, you will get to learn why should you join the MEPL classes. A brief introduction about the history of a classes has been given here. You also will get to learn about the vision and mission of MEPL classes on the website. Below that, you will see all the faculties along with the founder member are being listed here. You will understand and get to know more about that, about all the faculties associated with the MEPL. You, as a ACCA student, are is expected to visit this menu of courses where you will find the international courses. In international courses, if you look carefully in the categories, there are two categories listed here. One is the ACCA and another is CFA. So if you go to the ACCA category, you will get to learn various courses which have been offered by MEPL classes, and heavy discounts are currently being offered to a student as a part of a growth strategy of MEPL classes, right? So I encourage all of you, I request all of you to get the maximum benefit of these courses. Enroll yourself as much as you can. Also share the link and the course details with your colleagues, friends. No matter if you are a full-time student or a working professional, these courses are open for all, right? So now let's move towards the ACCA. So we have three levels broadly in ACCA, wherein at third level we have strategic business leader as a paper, as a subject. Then we have strategic business reporting. I believe that you have the fair idea of first two levels of ACCA, so I'm not going into the details of that. So our subject is advanced financial management AFM. Uh, Other than the strategic business leader and strategic business reporting, we also have the advanced financial management, advanced taxation, audit and assurance, and the business strategy like subjects. Okay, so I hope you guys have choose the AFM for this level. And if you look at the unit wise structure, so broadly this whole uh, subject of advanced financial management has been divided into the 15 units. First unit will be role and responsibility of the financial manager. You guys are expected to play a role of a chief or head of a finance department, right? So theoretically, this text in the first chapter will give you the brief idea of what this is all about. Then second unit, okay, 1 minute. Before we get into the courses, let me again introduce you to the website. I have briefed you. So you are expected to go to the courses and then international courses. Website is www.meplclasses.com. In categories, you will get to see the two international course categories has been listed. One is a ACCA and another is CFA, right? So as I mentioned earlier, there is a huge discount going on for ACCA courses. So I would request you and encourage you to take a maximum benefit of this. And now further coming to the units. So first unit is about the role and responsibility of a financial management. Second is the investment appraisal, which we are going to have a look today. Then international operation and international financial management are there. Then how to make a financing decision, fourth unit is there. Then about the dividend decision, a specific unit is there. Then there is a weighted average cost of capital and risk adjusted weighted average cost of capital. So if you look at the unit number 1 to 7 carefully, this is nothing but advanced level enhancement of all those topics which was already there in the second level. So what is the difference? That uh, a bit advanced problems and advanced concept we will be learning here. We will be straight away starting with these topics in our prime initial lectures. Okay. Then what you have not uh, gone through earlier or the previous level is the option pricing, introduction to a risk management, how to hedge the foreign exchange risk, how to do the hedging of interest rate risk, what are the strategic aspects of acquisitions, the broader and the detailed and intense view of a business valuation, what is the meaning of corporate failure and corporate reconstruction, and 15 unit is about the employability and technology skills, which we are not going to cover through the lecture, but you are expected to read this. So broadly, if you ignore the first theoretical part, there are 13 main topics or units or say uh, chapters which we are going to learn. So let's before so today we are supposed to start the second chapter, which is investment appraisal. Okay, definitely not going to be a very difficult unit, a very easy unit for all of you. But before we get into the textbook, let's try to revise few of the basic concept like how do we do. So, what is the investment appraisal? So, a simple question will come in your mind whether we should accept or should not accept a particular project. So let me give you the a very basic question. Okay. Also, we will revise how do we make a calculations and derive the answers. So the question is, say ABC Limited is considering to invest say dollar 50,000 in 5 years project. Over the period of 5 years, the annual cash flow, see, I'm using the word cash flow of the project is expected as follows. So the question will give you the brief about the annual cash flow. So say year 1, 2, 3, 4, and 5 is there, and cash flow is expected to be say $8,000, $10,000, $15,000, $20,000 and say $22,000. And the question will also give you the cost of capital. I will explain what is the meaning of cost of capital when we move ahead with the topics. So just for a revision purpose from the level 2, we are taking this question. The cost of capital is say 9%. So question is required. Calculate first net present value and second profitability index. Yeah, I hope all of you will be much comfortable with this concept. So how to solve this? Okay, so very easy. Let's try to calculate. So we will say the first part of our answer as calculation of net present value. Cost of capital is given, so we will mention it at 9%. So here we will list year. Here we will list cash flow. Here we will have to list present value factor at 9%, and here you will get the present value of cash flow. So year is 1, 2, 3, 4, and 5, and our cash flows are 8, 10, 15, 20, and 22. So how to get a present value factor at 9%? Formula is pretty clear. Present value factor will be 100 divided by 109. So for a simplicity, let me call it as a 100 divided by 100 plus 9, because cost of capital is 9%. So if it is 10%, it will be 100 plus 10, 12.5, 100 plus 12.5, and so on. And raised to power will be the year. So this is a present value factor for the first year. This is for the second, third, fourth. You can use up to 3 decimals if you want, or more are also good, but it is expected to at least use 3 decimals. Okay, 4 decimals are also good, no worries. So by now you should remember 0.917, 0.842, 772, 708, and 650 are the present value factor. Many times it will be given. If you look at the study material, these factors are generally given in the examination. Present value is nothing but a product of a cash flow and the present value factor. So 8,000, which we are expecting to receive at the end of a first year, has a present value of $7,339. So here, if not required, you can altogether exclude the decimals. That is all fine. There will be no issue. So similarly, if you list out the present value of a cash flow which is expected to receive in the future, make sure you are using the correct discounting factor. So sum of these will give you the present value of cash inflow. It means by investing $50,000 today in a project and by receiving 8,000, 10,000, 15,000, 20,000, and 22,000 over the period of 5 years, which sum up to 75,000 rupees, the present value of which is 55,000. So here also, here if you subtract or deduct the present value of cash outflow, outflow means money going out, you will get the net present value. We call it as an NPV. So NPV is nothing but a net of present value of inflow and present value of outflow. So this was the very basic question. We did a calculation of a net present value at 9%. So if someone asks you to calculate a profitability index, it is also easy. Let's give a heading as a calculation of PI, profitability index. So first, you need only two things to calculate the profitability index, is the present value of inflow and the present value of outflow. If you have these two values readily available with you, you can very well calculate the profitability index. So the formula to calculate the profitability index is present value of inflow divided by present value of outflow. Pay attention towards the formula. It is present value of inflow divided by present value of outflow. So two decimal will be enough. 1.12 is the profitability index. Now, how to interpret it? In terms of interpretation, we say that if present net present value is greater than 1, or if the net present value is positive, the project is acceptable, and if it is not, project is not acceptable. So read carefully the question. If they ask you to calculate, just make a calculation, that is enough. If they ask you to provide a comment also, then only say as the NPV is positive. Why NP is positive? Because present value of inflow is greater than the present value of outflow. The project or say proposal to invest should be accepted. Similar logic applies to profitability index. What is the formula of profitability index? PI is equal to present value of inflow divided by present value of outflow. This is the formula. So any division will be less than 1 or will be greater than 1. Depends on what is the numerator and what is the denominator. If numerator means present value of inflow is greater than the denominator, present value of outflow, the fraction, the answer will always be greater than 1. So here, while making a conclusion, we would say that as the profitability index is greater than 1, the project should be accepted. So what do? We, if given the cash flow is given, that is all fine. If cash flow is not given, we would first identify the cash flow, then we'll apply the given cost of capital if it is given. If cost of capital also not given, we will have to find out the appropriate cost of capital. I will take you through the details of all that. I'm for the purpose of this question, I'm just believing that all of you have the very fair idea of what we learn in second level of ACCA, right? So if everything is given, if the cash flow is given and the cost of capital is given, we just simply need to calculate the present value of cash inflow and present value of cash outflow also. In some cases, if outflow is not a single point outflow, but if outflow is happening at a multiple levels, we will also assess that. Okay, so let's twist this question a little bit. same question. So let's call it as a question number 1. Similarly, we will frame a question number 2, but with a little different values. And let's try to understand what is the difference. So say in question number 2, I am making initial investment as 80,000 instead of uh, 50,000. So the question remains the same. There is a proposal wherein today we are required to invest 80,000 in a 5 years project, which in turn is going to give us a cash flow of 8,000, 10,000, 15,000, 20,000, and 22,000. And the cost of capital also remains the same, say 9%. So we are required to calculate net present value and profitability index. So say calculate and comment on net present value and profitability index. So I'm specifically mentioning we have to calculate and we have to make a comment on that. So now see how it is different from what we have learned earlier. So as far as the calculation of a net present value concern, nothing will change because cash flow we have not changed from the previous question. Uh, our cost of capital has also not changed. So present value of cash inflow will remain same. Just this part, present value of cash outflow will not be 50,000, but it will be 80,000. It means from this project, we are expecting to receive the cash inflow of $55,806, while our cash outflow is expected to be $80,000. So our net present value is going to be negative and not the positive. So if you look at this carefully, you will understand why NPV is negative, because the money which is coming in is lesser than money what is going out in terms of a present value. Okay, in absolute term it may be different, but in a present value term the present value of a cash inflow is less than the present value of a cash outflow, which makes the NPV negative. So our comment or the assertion will change a bit. We will say as the NPV is negative. Why NPV will be negative? Because the present value of inflow is now less than the present value of outflow. The project or proposal should not be accepted. Similar calculations will be applicable for calculation of a profitability index. So here present value of inflow is 55,806, while the present value of cash flow remains 80,000, and our profitability index, the formula of which is present value of inflow divided by present value of outflow, means 55,806 divided by 80,000. This division will be less than 1 because here numerator is less and denominator is greater or more than the more. So therefore PI will be less than 1 and our comment will slightly change now, as the PI is smaller, lesser, whatever you want to use, you can use, than 1. The project should not be accepted, right? So this is what we used to do in our basics level, and we have learned how to solve these kind of questions. Now, trick is that in this question, the cash flow was given. What if instead of a cash flow, they give us a profit? So I will again change the same question slightly, very slightly, to just to let you know how do we derive the cash flow in case the profit is given. So pay attention, be careful. It is not going to be difficult at all. So I'm framing a third question for you. ABC Limited is considering to invest 50,000 in a 5-year project. Over the period of 5 years, the annual, instead of cash flow, I am using profit before depreciation are expected as 8,000, 10,000, 15,000, 20,000, and 22,000. This is the profit before depreciation. Now let's change the cost of capital to 10%. Okay. Now you are required to calculate the net present value and the profitability index. And we will also give you the rate of depreciation is say 20%. So read the question carefully. In earlier question, the cash flow were given. Here, instead of cash flow, they give us the profit before depreciation and taxes. So no depreciation is charged, no tax is charged. Rate of depreciation is 20%, tax rate is say 30%. So now question is a bit different than what it used to be earlier. So here, before making a calculation of NPV, we will have to make a calculation for the depreciation. So method of depreciation is also not given. So we can assume whether it is a straight line depreciation or WDV. So solution, we called it as an working note number 1. And let's name it as calculation of annual depreciation. And we will also assume written down value method of depreciation, WDV method of depreciation. So it is not at all difficult to calculate a depreciation. We will have the year, we will have the opening WDV, we will list depreciation at what is the rate of depreciation, 30%, and we will have the closing WDV. So year 1, 2, 3, 4, and 5, because the life of a project is 5 years, so we assume that the life of a asset is also 5 years. Initial investment in this project is expected to be $50,000. So let's assume that this is the cost of a asset which is going to be depreciated. So 50% annual depreciation will be the opening WDV multiplied by rate of depreciation, and the closing WDV will be opening WDV minus depreciation. Closing WDV will become the opening WDV for the next year, and the depreciation pattern would follow. So if you look at the calculations carefully, you will see 15,000, 10,500, 7,350, 5,145, and 3,602 are the annual depreciation, right? So once we have the depreciation, we can derive the net profit. So we will call it as a working note number 2 and just name it as a calculation of net profit and CFAT, which will be called as a cash flow after tax. See, this is a very crucial and important concept, guys. Thing is that in this question, we were not given the cash flow. But the question give us the profits. Now we have to convert the profits into the cash flow, because whatever discounting factor you are going to apply to calculate the net present value will be applied on a cash flow and not on a profit. Cash flow and profits are two different things. The investment decisions, particularly based on the net present value and all, are to be applied on a cash flow and not on a profits. So how to convert the profit into a cash flow? So here we will list year 1, 2, 3, 4 and 5. We will have profit before depreciation and taxes. That is what is given in a question. 8, 10, 15, 20 and 22,000. Now, as this is the profit before depreciation and taxes, we will subtract a depreciation first. Depreciation we already have. So after applying the depreciation, we will get profit before tax. Profit before tax will be profit minus depreciation. There can be profit, there can be a loss. Then we will like deduct a taxes. I guess I have made a mistake. Depreciation has been calculated at 30%. So let's make it a 30%. No, keep it 20%. I will change the calculation here. Instead of 30%, I will calculate the depreciation at 20%. No worries, it's your job if I am making bit different calculation, correct me, that is all fine. See, I have a chance to redo the things because I am a teacher and I have already passed and qualified the examinations. As a student, you don't stand this chance, okay? So be careful while you do these things in an exam. But yeah, there is always a scope to go back and correct yourself. No worries. So less taxes. If there is a loss, there will not be a taxes. There will also be a clause that you can carry forward your losses to the next year. Okay. So let's not get into that. Whenever the question will suggest, I will tell you how to do that. Here, let's assume that in case of a loss, assume no carry forward of losses is allowed. So if there is a profit, pay tax. If there is a loss, don't pay tax. So taxes at 30%, right? So here there will be a tax. If 2000 is a profit, we will be paying a taxes. And after deducting a taxes, what we get is a net profit or profit after tax. But it is still not a cash flow. It is still not a cash flow. Here is a loss, and here you get a profit after taxes after deducting the taxes. Formula is simple: profit before tax minus taxes. So once you get a net profit, you have to add back the depreciation. This technique we have already learned at earlier levels. So I'm again not going into the details of why do we do that. So this is the value of a depreciation. If we add, we get CFAT, cash flow after tax. and the formula is net profit plus depreciation. So even though the profits were 8,000, 10,000, 15,000, 20,000, and 22,000, our cash flow is going to be 8,000, 9,400, 12,420, 15,536, and 16,629. So this is important for us to understand. How do we derive the cash flow if the profits are given? So now we have the cash flow, we can calculate the net present value. So that calculation will be similar again. Here, year-wise, you have to list your cash flow. Now, present value factor is not to be considered at 9%, but at a 10%. So I'm going to change the formula. 100 divided by 110 raised to power year. So my calculation changes. 8,000, which we are expecting to receive at the end of a first year, will have a present value of 7,273 today. Similarly, for the cash flow of other years. So here we have the present value of a cash inflow as 45,000. Present value of a outflow is 50,000. So our net present value is negative, and our comment will be as the NPV is negative. Why it is negative? Because present value of inflow is now less than the present value of outflow. The project or proposal should not be accepted, or it is not worthwhile to do so. Same case will be for applicable for the calculation of a profitability index. We have the present value of a cash inflow as 45,000, present value of a cash outflow as a 50,000. So our PI will be less than 1, and we will say as the PI is less than 1, the project should not be accepted. So this was the warm-up question on calculation of net present value under different scenarios. When directly the cash flow is given, that is also fine. And in case cash flow is not given, rather we are given the profits also, there is no need to be scared. We can very easily convert the profits into the cash flow. How did we do that? We first consider the profit before depreciation and taxes. Then we subtracted the depreciation, we get the profit before tax. Then we deduct the taxes, we get a net profit. Then we added back the depreciation and we get the cash flows after tax. Quite easy, quite easy. So now, as I told you, your first unit is about the role and the responsibility of finance manager. Let me briefly and quickly take you through the first unit. The role and the responsibility of a financial manager. Because as I mentioned earlier, you are going to play the role of a finance manager once you qualify as an ACCA. No, not immediately, but if you have the degree and the experience, and of course, you are genuine and hardworking person, no one can stop you from being a finance manager or the chief finance manager of a company. So theoretically, if someone asks you what are the key role and responsibility of a financial manager, what do they do? So you will have to answer your question about your roles and about your responsibility, considering the strategic impact of this role, financial impact of this role, regulatory, legal impact of this role. Of course, all your um, working or your role has to have a ethical impact, because nowadays you must be going through the news is that many corporates are involved in some kind of unethical practices, whether it is about raising the funds or following the uh, uh, regulatory guidelines of regulators like SEBI is in India, SEC is in USA. And also, whatever you do should also be the environmental neutral, that none of your decisions should harm the environment also. So it's not about writing the just answer to a question, what is the key role and responsibility. To see, basically, questions which you are going to face in an examination will be like a case study kind of a question. Okay. So read it carefully. I will also take you through what kind of a questions you can expect. This is a Kaplan publications material which we are referring currently. It's a very good material to prepare for the ACCA exam. Read the theory carefully about and try to understand what are the key roles and responsibilities of a finance manager. So as a finance manager, you have the ethical and social responsibilities. Your main motto will be to protect the interest of your stakeholders, particularly the shareholder and the management. Then you will also be responsible for corporate governance. And of course, development and growth has to be there, but it has to be a sustainable one. You will also be framing and drafting the financial policies for your organization. So, what functions or what task you will do as a finance manager? You will be making a decision about which investment is to be selected based on all those techniques. Right now, we see how to calculate NPV and profitability index and all. We have the separate chapter for that. Uh, how to identify and determine the overall cost of finance. If you made the profit, what to do with that profit? Should it be distributed as a dividend, or you want to retain and not to distribute the dividend? You will also be responsible for making a communication with your stakeholders. You will also be responsible for financial plannings and control. Risk management. Our unit number 8 to unit number 14 are mostly based on this topic, risk management. Because if you are managing the finances, it's not just about managing the finances, it is equally about managing the risk as well. And efficient and effective use of resources. This is what we do. Whatever resources are available with you, make sure you are making an effective and efficient use of that. So there are much details about your role and responsibility in these text below. So you are expected to go through it. I mean, I will also be explaining all those techniques and methods of making a decision or selecting an appropriate investment which is listed here. We have the topics on that, where you will actually learn how do we do that and then come back. Not necessarily at the end of a first lecture you should you start pick up a page and start reading that. Instead, take a time, go to the units, see and understand what we are learning, why we are learning, and then I guess you will be able to connect yourself with the first unit, what is being listed there. Okay, so now we'll take you to the second unit, which is again an important unit. It is about the investment appraisal. Basically, we will call it as an investment appraisal techniques. What are the methods? What are the techniques of investment appraisal? So be with me. We will be straight away going to take a questions, and also we'll explain how to solve those questions, how to answer those questions. Yeah. So this is again our first topic for our learning, which is the calculation of a net present value. A variety of questions you will see here. So let's say again how to calculate that formula for present value and how to do it. Discounting is given here, which I have already explained to you. Now, a little advanced topic here for us is to analyze the impact of inflation. See, I tell you how it is different from what we do at a basic level. So here, when we say that our profits, our cash flow for the first, second, third, fourth, and fifth year are expected to be this. Will there be the effect of inflation in that? Yes, definitely. Suppose you are paying a wages of 5,000 per year. For the next 5 years, it is not expected to remain 5,000, right? Because due to the inflation, you are expected to, you can expect that the wages will increase. Also, your selling prices will increase, right? And your cost will increase. So if this kind of question comes up, how to deal with that? So let's straight away start with a question, I guess, that will help you more rather than going by the theories. Hmm. Now, this is a very beautiful question. Okay, it is an illustration. So, in this study material, I will be explaining the concept to you through the illustration, and there are questions which you are expected to go through and solve. Right now, pay attention. Read the question carefully. Question says, a company is considering investing $4.5 million in a project. Means today's outflow, cash outflow, is expected to be $4.5 million. Okay, and achieve an annual increase in revenues over the next 5 years of 2 million. Here they say in coming 5 years, every year we are expected to achieve the sale of a $2 million at a current price, of course. The project will lead to an increase in a wage cost of 0.4 million per year and will also require expenditure of 0.3 million per year to maintain the level of existing asset to be used for in a project. So here we know that today our cash outflow is going to be 4.5 million. Our sales revenue is going to be a 2 million per year. And out of these 2 million, we will be paying a wage cost of 0.4 million each year. That is again a cash outflow. So various cash inflows and various outflows of each year has been given. Also, we will have to keep spending 0.3 million each year to maintain the level of the existing asset to be used in a project, because these assets will depreciate. We will have to make an additional investment. additional investment in working capital equivalent to 10% of a increase in a revenue will need to be in place at the start of each year. So whatever your revenue will be in next year, suppose in second year your revenue is expected to be 10 million. So 10% of that, 0.2 million, you will have to invest in a working capital. So lot of additional things are given here. Considering all those factors, you are expected to first derive the correct cash flow and then apply the given discount rate to find the net present value. Also, they say the following forecasts are made of a rates of inflation each year to the next 5 years. Revenue, your current revenue level is 2 million, right? It is expected to increase by 10% each year because due to the inflation, the prices of your product will also increase. You are not going to sell your products at the same price for the 5 years, right? Wages currently you are paying 0.4 million, which will have the rate of increase of 5%. Your asset maintenance cost will also increase at 7%. And overall, general prices, this is also important. So, if you carefully read at the theory given above this illustration, you will find that a item specific inflation rate is sometimes known. And if you take an average, it is described by the general price level. Overall, on an average, inflation is going to be 6.5%. The real cost of capital of a company is 8%. Which cost of capital is given? A real cost of capital. So when we find the net present value or the present value, we find present value of a cash flow. And our cash flow is always a nominal cash flow and not the real cash flow. So if we have the nominal cash flow, make sure we apply nominal cost of capital. If the cash flow is nominal, cost of capital will also be nominal. If the cash flow is real, the cost of capital is also going to be real. It is different concept. Pay attention. So, first we will derive the cash flow. It is been given here, similar working we will be doing. So this is illustration on page number 53 as per my notes. Current level cost and revenues. This is given, ये given है हमको, right? And inflation rate is also given. So let's call it as a particulars. So current level of a sale is 2 million per year. And expected increase in a sale is given at 10%. So wages are also given. Current level of wages, look at the question carefully. It is 0.4 million. and the growth rate or the inflation rate in wages is expected to be 5%. Similarly, asset maintenance cost at a current level it is given at 0.3 million and the growth rate is expected to be 7%. So considering these factors, we can have the estimate future revenue and cost. So let's list the year here. 1, 2, 3, 4, and 5. Let's call it as a revenue or say sales. So if the current level sale is 2 million and it is expected to be increased by 10%. So next year it is going to be 2.2 millions and it will keep increasing at a rate of a 10% each year. So we get expected revenue for all those years. If these numbers are bigger, you can use the amount in million also, no problem in that. Less we will do wages. From sales, subtract the wages. If current level of wages is 0.4 million, it is going to be increased by 5%. So we will multiply it with 1.05. And similarly, it will keep increasing by 5% each year. So here we get annual wages. So from the sales, if you subtract the wages, we get your operating cash flow. The cash which is going to be generated from the operations, not the profit I am saying, okay, this is not a profit. Sale is your cash flow, wages is your cash flow. So your operating cash flow will be sales minus wages for the next 5 years. From this, wages, now you can subtract another cost, which is your asset maintenance or replacement cost. Asset replacement cost, or you called it as an maintenance cost. Anything will be fine, that is all right. At current, it is expected to be 0.3 million, which is going to be increased at 7% per annum. So just list it out and then you get free cash flow and working capital also. So look at the question here carefully. What do they say? The additional investment in working capital equal to 10% of the increase in the revenue will need to be placed at the start of each year. By whatever amount your sale is going to be increased, you have to place the equal 10% amount of that your expected sales as a working capital, right? So let me tell you how do we do that. So let's make a working note and name it as a calculation of working capital requirement. So we will list here as a year 0, 1, 2, 3, 4 and 5. Our expected sales we know 4 million, 4 or 4.5, 2 million. It is expected to increase by 10% each year. So our expected sales for 5 years now we know. So increase in sales. So from 0 it is 2 lakhs. This increase is first year sales minus previous year sales, and this increase again the current year sales minus previous year sales. This increase is against current year sales minus previous year sales, current year sales minus previous year sales, current year sales minus previous year sales. They say working capital requirement will be 10% of increase in sale. So 10% of whatever your sale is going to be increased in the next year, means first year, you'll have to invest the 10% of that. So next year we will require the 2.2 million of sales. So your working capital requirement will be 2,20,000. Now, based on your increases, you will have to keep the additional working capital. So this will be your working capital requirement in year 0, 1, 2, and 3. So we will put one more column here for the 0 year. So right from the 0 year, you are expected to put the amount invested in your working capital. Less the investment in working capital. Okay. So If you have all those figures ready with you, and let's say initial investment also we will quote, and we can quote it later also. Okay, so we will say cash flow is equal to sales will be plus operating cash flow we already have. From that, we are going to subtract the asset replacement cost and investment in working capital. So first 0 year, there will be the negative cash flow. Second year, operating cash flow will be 1780 less there will be the asset replacement cost and investment in working capital. Similar for the second, third, fourth, and the fifth year. So if you look at it carefully, over the period of 5 years, your total injection in a working capital is 3,22,102 dollars, which will be returned to you in the fifth year. So this is nothing but a return of your working capital. Working capital means what? You put the money when your business starts, and at the end of a business, you withdraw back that money. So this will not be our cash outflow, but will be our cash inflow. Now we have this cash flow for each year. Now we can calculate the NPV, so initial cost also. So let's say I will make it simpler for you, a bit simpler to understand. Your initial cost is going to be 4.5 million. And let's say return of working capital. All that working capital which you have invested so far will be returned back at the end of a fifth year. There is no scrap value and anything is given. Okay. So now here we get a net cash flow is equal to your cash flow is negative. Your initial cost is also your cash outflow. And if a return of capital is there, it will be your cash inflow. You can always vouch and verify this. Right. Now you can apply the present value factor. But there is a twist. Now this is your cash flow. Which cash flow? Nominal cash flow. Money cash flow you call it. On this money cash flow or nominal cash flow, we can't apply the real cost of capital. So I will put a note here, note. In this question, the cash flow from project is money cash flow. or nominal cash flow. One and the same thing. But the cost of capital given is the real cost of capital. As per rule, as general rule, we say if cash flow is real cash flow, we apply real cost of capital to get NPV or whatever. But if the cash flow is money cash flow or nominal cash flow, we have to apply nominal discount rate. This is the rule. So we will have to now convert the nominal discount rate of 8% by applying the general inflation rate to the real discount rate, multiply real discount rate with general inflation rate, you will get the nominal cost of capital. So formula is 1 plus nominal rate is equal to 1 plus real rate multiplied by 1 plus inflation rate. We know everything. So we have to find the nominal rate, no? Because cash flow is nominal. So 1 plus nominal rate will be equal to your real rate of discount is 8%. Okay, so we will call it 0.08 plus inflation rate is 6.5%, which is given in a question 0.065. So if you solve this, you get 1 plus n is equal to 1.08 multiplied by 1.065 is equal to 1.1503, and therefore n is equal to -1. In terms of percentage, we can say this multiplied by 100, it will be 15.02 or simply say 15%. So now we can do a calculation of a present value, net present value. At 15%. So here we have here cash flow, present value factor at 15%, and now we will have the present value of our cash flow. 0, 1, 2, 3, 4, and 5. This is my cash flow. Present value factor at 15%. You can always use the lesser amount, okay? 15% will be like 100 divided by 115 and raised to power year. 3 decimal will be good. Yeah. And present value will be your cash flow multiplied by your present value factor. No need to use the decimals here. And here you get your net present value, which is 1.387 millions. So their answer is 1.389 because they have doing it in a rounding off. One and the same thing, no issues. So if you understand this illustration, based on this illustration, there will be a similar question called as a test your understanding. This will be like your homework or say home assignment or practice question for you, right? Do it carefully. We'll take a short break of 10 minutes and we'll be back again. This is 3 hours lecture, right? So there will be a 10 to 15-minute break in between and we will be back again. All right, guys, welcome back from the break. And resume this session now. Okay. So, I hope you understood this first illustration and test your understanding when you are supposed to solve. Next is a revision of a taxation on operating cash flow. We already had a warm up question on that. Let's try to solve the question. Okay. So now we have another illustration. So as I told you, this is your study material, a Kaplan publication study material. This is what we will be using. Okay. I will be taking you through all the solved illustrations and test your understanding is what you are expected to solve and the end of the chapter questions. Okay, now pay attention here. A company buys an asset for 26,000. So today our cash outflow is 26,000. It will be used on a project for 3 years. Life of a project is 3 years. After which it will be disposed of on the final day of a year 3 for rupees 12,500. So case is pretty simple. Today cash outflow is going to be $26,000. After 3 years, $12,500 is going to get back. Tax is payable at 30%. On what you will pay the taxes? You will pay taxes on your profit and not your cash flow. Allowable depreciation is available as 25%. Don't mess up with the rate of depreciation, rate of taxes. Uh, have a careful watch on this while you read the question. Okay. On reducing balance, that is good that they have already mentioned the method of depreciation, which is the reducing balance method. And balancing allowance or charge should be calculated when asset is sold. Now, this is very important factor, I must say. The balancing allowance or charge should be calculated when asset is sold. So, asset is going to be depreciated fully. All 26,000 will be depreciated. It means what? If you apply the depreciation rate of 25% on a reducing balance method, the value is never going to be zero. So 25% in a first year, 25% in a second year, and whatever WDV is there at the beginning of third year will be completely depreciated in the third year. That is what this sentence specifies. इसको ध्यान से समझना है आपको. Net trading income from the project is 16,000 per year. Each year our cash inflow is going to be the $16,000. And the cost of capital is 8%. You are required to forecast the free cash flow. Means cash flow after tax for the project and determine whether it is worthwhile using the NPV method. The simple thing, whether project should be done or it should not be done. So first of all, we will be calculating the depreciation. Okay. So let's get back to our Excel. Now this is illustration on page number 57. First of all, let's call it as a working note number 1. Name it as a calculation of annual depreciation. So the calculation is again simple. We will have year, opening WDV, depreciation at 25%, and we will have the closing WDV. Year 1, 2, and 3, just a 3-year of project. Opening WDV is 26,000. Depreciation will be 26,000 multiplied by 25%. And closing WDV will be opening minus depreciation. Closing WDV will become the opening WDV and similar thing. Now pay attention here very carefully. Now the opening WDV for the third year is 14,625. If you genuinely apply the 25% of rate, depreciation will be 3656 and the closing WDV will still remain 10,000, but which is not a case. Here, the closing WDV will be the balancing charge 14,625. That is what they mean. And their presentation is different. I will take you through. Sorry, closing WDV will be the sale value 12,500. So the difference between the sale value, see, if you apply the 25%, depreciation is going to be 3656, right? So they want the balancing difference between the opening WDV and sale value to be the depreciation for the third year. This is what they mean. Pardon me. So we have done with our depreciation calculations. Now cash flow is given, depreciation is given, tax rate is given. So we will be making a calculation of, let's call it as a note number 2. Calculation of a free cash flow. So we will have year as 1, 2 and 3. Sales is given 16,000 per annum. What do they call? Sale proceed or what? Net trading income, sorry, not sale proceed. They call it as a net trading income. Now this is the trading income from the sale and purchase and operating expenses. Less we will do depreciation. We will get profit before tax. This will be net income minus depreciation. We will be subtracting taxes at, what is the rate of tax? 30%. So profit multiplied by 30% will be your tax amount. And now you will getting profit after tax. Will be profit before tax minus taxes. Now you add back depreciation. You get free cash flow or cash flow after taxes, one and the same thing. Now you have the cash flow. Now you can do calculation of NPV at, what is the discount rate? 8%. Again, same thing. Here, cash flow, present value factor or called it as a discount factor at 8%, and you get a present value. We can add a description or particulars also, no problem. Here is a 0, 1, 2, 3 and again 3. Tell you why. Because you are going to get a scrap proceed back. That is important consideration while solving these kind of questions. So in year 0, you will have initial investment, which is your $26,000. Then you will have annual cash flow, free cash flow, and then you will get your scrap value or sale proceed. So your annual cash flow is going to be this, and this. Your initial year's cash flow will be negative because this is going out, and 12,500 is what you are going to receive. Present value factor will be 100 divided by 108 and raised to power this year. You can always use 3 decimal, and your present value will be cash flow multiplied by the present value factor. See here, third year's factor has been repeated twice because scrap value which you are going to get is in a third year itself. If you sum it up, you will get net present value at 8%. Why there and our value is different? 26,000, first year 96. Formula is wrong, my mistake. Yeah, 16,352, 353, all good. So this is how we get a NPV. But question does not end here. Read the question carefully. What do they say? Comment. They also want forecast the free cash flow of a project and determine whether it is worthwhile using the NPV method or not. So we can say that we can always put our expert comment here as the NPV of project is positive, it is worthwhile to invest in project. That's it. That will be enough. Fair enough. You will get 4 marks for this. Any doubt? Any question? Feel free to raise your hand. Okay, so if you see below, there is a question for your practice. Test your understanding too, which is your homework for a day. Give it a try. I don't think that you will not be able to solve it. Answer is also there in the same material at the end of this unit. Okay. Now, the very important topic is the calculation of IRR, internal rate of return. I tell you what is this. Okay, so let's get back to the basics again. Internal rate of return, IRR. Why do we call it? See, pay attention, okay? The concept that is more important. So conceptually what happens, suppose you are a finance manager, okay? And now suppose you are leading a project and your target is to say collect 1 lakh rupees or say 1 lakh dollars for your project. And so you decided, let's go get back to the people and convince them to invest in your project. So suppose you meet Mr. A first. You explain him that, sir, we have a very beautiful project with us, wherein the cash outflow will be 26,000, cash inflow will be 13,000, 12,000, 11,000, and you will also get a scrap value of 12,500 back. Invest in our project because NPV is 16,352. And the person will be like, why you say that the NPV is positive? Then you will be like, sir, we have applied a discount factor of 8%. But what if he says, I am not a person who is going to invest in your project at 8%. 8% is too less for a person like me. I will give you money if I get a earning of 15%. What you will do? Wait, sir, wait. Hang on a minute, sir. I have a quick solution for your question. And you will be like, then, no worries, sir. Just a simple thing. Let me just simply convert your discount rate from 8% to 15%. Let's see. This is what you will do, no? So you will again open your laptop, will make it a 15%. And then we'll again recalculate. And then you will reach a conclusion, sir, at 15% also NPV is positive. So let's take, say, initial investment is 35,000. And annual cash flow for different year is different. Okay. So I just change the question. So here you will see that this is a particular project wherein you will have to invest 35,000 today. In return, you will get, I will make it more simpler for you. Okay. 13,500, 12,500, 11,500, and 12,500. And NPV at say 15% is now positive. Okay, you go to some other person with the same proposal and tell him, sir, invest in our project. The NPV of our project is positive, and you did this NPV say at 12%. And your NPV at 12% is positive. What if this person says, no, I don't want to invest anywhere where I will be getting a return at 12%. I'm expecting even more. So you will ask him, what is your expectation, sir? Like 20%, 20% milta hai to bolo. I will say, wait, sir, 1 minute. What a big deal is there? Just a change of formula, and I can quickly tell you the NPV at 20%. Oh my God, now it is negative. What? It means what? This is a project where is, if someone is expecting 15%, it is good option for him because NPV is still positive. If he is expecting 12%, it is even good for him. But if someone wants a 20% of return, this investment project is not for him. Now you will be like, why would different people will have the different expectation? Of course, man, it they will have. See, let me give you an example. I don't have a business to do as such because I'm in a service sector. So what do I do if I have money? I simply put my money in the fixed deposit. I go to State Bank of India. They hardly offer me 7-8% per annum, and I'm fine with that. Even if you look at your dads, many of your parents, they will be like, "Oh, I don't want to take a risk. I'm happy with 7% because they expect 7%. If something gives them 7% per annum, they are fine to put their money there." But there are some people who is like, 7% is not a return anymore. At least, man, 15% we should take a chance. So they will try to invest in a mutual funds or equities. There will be some people like at least 20-22-25% मिलना चाहिए साल का. So they will lend their money to someone on interest. 2% हर महीने का 2% per month interest लेते हैं अपने आप को. 1.5%, 2%. So it gives annualized return of 18% to 24%. So what is this? If you look at the broader perspective, what is this? You will see that the different people have the different expectations. Then it will be very difficult to convince them on a ground that invest in my project because the NPV is positive. Your NPV is positive because you have applied your particular rate. If that rate has increased or decreased, your NPV will move. So general rule is that higher the discount rate, lower will be the NPV. There is an inverse relationship between the interest rate and the NPV. As you increase, see, 12% NPV was very higher. 3,000. 15% 800, and at 20% it will be negative. So if you again, just for your understanding, I'm doing it again and again. Okay, so let's say here at a 12% NPV is positive, I will make it a 10%. NPV is even higher and positive. If you look, 12% also it is positive. At 15% also it is positive. Let's try it at an 18%. Now it is negative. At 20% also it is negative. So look at this cash flow. 10% and any rate below 10% it will be positive. 12% at any rate below 12% it will be positive. It is still positive at 15%, but it turned negative at 18%. And it again went negative at 20%. If you pick any rate, once it becomes negative at a particular rate, it will be negative only. So say instead of 20%, if someone is expecting 24%, it will even turn negative. ये निगेटिव आता जाएगा और बढ़ता चला जाएगा. तो ऐसे वक्त में क्या करें? अब हर कोई अपना एक एक्सपेक्टेशन बताएगा. Every person will have their own expectation of how much they want to earn. As I told you, some are even satisfied with 6%, some want 10%, some 20, some 24, and there are few people who are like, पैसा डबल 24 दिन में पैसा डबल होता है तो बोलो, नहीं तो पैसा ही नहीं लगाना. So it all depends on the expectation of a person. तो ये जो एनपीवी का मेथड है ना, it has a limitations. So you can't work out the NPV at a different rate for different people. So एक बात तो समझ में आ रही है कि जैसे जैसे मेरा रेट बढ़ता है वैसे वैसे एनपीवी कम होता चला जाता है. आर यू गेटिंग दिस पॉइंट? तो अगर यहाँ देखोगे आप ग्राफ पे, तो अगर यहाँ पर रेट लेता हूँ और यहाँ पे एनपीवी लेता हूँ, तो as and when the rate of discount will increase, NPV will decrease, and this will give this kind of a slope, called it as an NPV curve. But somewhere in this, a point will come, a rate will come where NPV will zero. At a particular rate, NPV is equal to zero. Now what will happen? Any rate above that, NPV will be positive, and any rate below that, NPV will be negative. This is what going to happen. Are you getting my point? Really, what is happening, that at a rate will come where NPV will be exactly zero. Any rate below that, NPV will always be positive, and any rate above that, NPV will always be negative. So getting that particular rate where the NPV will exactly be zero is called as internal rate of return. It means that that is a rate, that is a rate between two rates. At one rate where NPV will be positive and one rate where NPV will be negative. So I'll show you. Get back to the Excel again. You are seeing that at a 10% NPV is positive, at 12% NPV is positive, at a 15% NPV is positive, but at a 18% NPV is negative. Now somewhere between 15% and somewhere between 18%, between 18 and 15%, there has to be some rate, might be 16, 17, 18, whatever percent, where the NPV will be zero. So what is IRR? IRR is discount rate. It is a rate at which NPV is exactly zero. It means what? At any rate below IRR, NPV will be positive, always positive. And at any rate above IRR, NPV will be negative. Here, NPV will be between 15% and 18%, where NPV will be negative. So what is the formula? So formula is very easy. We need to first identify lower rate. Here lower rate is 15. Then we need to get a lower rate NPV. Here lower rate NPV is 899. We also need to get higher rate. In this case, higher rate, let's say 18%. You can pick any rate, any higher rate. You can even take 20%. And we also need to get higher rate NPV, which is negative 1135. That's it. These four things we need. So if I tell you what do we need to find IRR, answer is four things. Which four things? Lower rate NPV, higher rate NPV, and a formula. It is called as an interpolation formula. Formula is IRR is equal to lower rate plus and multiplied by higher rate minus lower rate. Look at the formula. IRR is equal to lower rate plus lower rate NPV. We'll also include a bracket here. This is the formula. IRR is equal to lower rate plus, not lower, sorry, lower rate NPV divided by higher rate NPV multiplied by higher rate into lower rate. Now just try to put values in this formula. See what we get. In our same question, our lower rate is 15%. Our lower rate NPV is 899. Divided by our higher rate NPV, my mistake, let me just correct it. Lower rate plus lower rate NPV minus higher rate NPV. Pardon me for this error. Our lower rate NPV is 899 minus it will be minus 1135. Multiplied by 18 minus 15. Now just solve it. See, this same formula is given in your textbook, but with different abbreviations. IRR is equal to lower rate plus lower rate NPV upon lower rate NPV minus higher rate, L for lower rate, H for higher rate, and N for NPV. Okay. Just solve it now. So minus minus will become plus 899. It will be 899 plus 1135. What is this sum? Eight 1135 2034. 2034. 899 divided by 2034, which comes to 0.44. 18 minus 15 will be 3. IRR 0.44 multiplied by 3 will be 1.33. And IRR will be 15 plus 1.33 is 16.33. Or you can say 16.33% because IRR is a rate. So if you have to use the proper bracket, you need to put up a bracket here. Now let's try to calculate the NPV of a project at 16.33. As I told you, somewhere between 15 and 18%. Okay. So 16.33% is between these two. So I'm just putting an additional space here. We will try to calculate the NPV at 16.33%. A rounding of difference will always be there. I'm just trying to make it more precise for you. Yeah. My exact rate is 16.29. That is all fine. They will not deduct your marks for 16.33 or 16.29. That is all fine. So I'm just making it 16.29 because of the rounding of differences. A small error might come instead of exactly 0. It will have plus 7, plus 8, sometimes plus 50 also good. That is fine. 30, 40, 50. And even if you mention the 16% as IRR, that is also. They do understand that thing. Rounding off, unless there is a huge difference of, you can write a 16 as a 18%. That is not a rounding off. Okay. Less fractions are considered. So 16.29 is a rate where NPV of a project is exactly 0. Any rate below 16.29, NPV will always be positive, as you can see here. And at any rate above 16.29, NPV will be negative, as you can see here. So if question comes in exam, how to find the IRR? Right? So step 1, do trial and error and find one positive NPV and one negative NPV. That's it. This is the first step. Do trial and error, find one positive NPV, find negative NPV. Step 2, apply the formula. That's it. That is as easy as it is. Nothing difficult. Okay. Now we will solve the question from the textbook. So let me take a question for you. Here is a question. Okay. An initial investment of 2 lakhs in a project yield a cash inflow of 500, 500, 600, 600 and 440 at 12 months of interval, means at each year. There is no scrap value. Funds are available at a cost of 12%. decide whether the project is worthwhile using NPV or internal rate of approach. So it is not a difficult, okay? As I told you, this is really easy. Finding NPV at 20% is very easy. And your decision will be like NPV is positive, accept it. If NPV is not positive, do not accept it. It is as simple as it is. Now we will do more trial and error and we'll find two NPVs, one positive, one negative, and then we'll apply the formula. How? Pay attention. This is, there is no illustration, I guess, on IRR. So I will solve the test your understanding for you. Page number is 59. Similar calculation of NPV at 12%. Okay, I will just put the values. 2000 is the initial investment minus 2000 and then 5566440. 5, 5, 6, 6 and 450. That's it. Now they want us to calculate the NPV at 12%. Just changing the formula. 12% means 112. That's it. My NPV at 12% is negative. So, what does it decide whether project is worthwhile? NPV at 12% is negative. Let me check. 5566440. 440 it is. Okay. It's still negative, no worries. And 12%. That is all fine. So, my comment will be as NPV at 12% is negative, use their language whether project is worthwhile. The project is not worthwhile. Now, if it is negative at 12%, if you use 13, 14, 15, 16, it will go on negative only. It means this project can't earn 12% return. So, if someone is there who says, I want to earn at least 12%, this project is not for them. Is it for the person who want to earn 11%, 10%, 9%? So every time you will have to find the cash flow. Why to bother so much? Instead, we know that if it is negative at 12%, it is going to be negative at any rate above 12%. But there has to be some rate below 12%. Maybe it will be positive. So let's do it at 8%. No? This is trial and error. I am just trying and checking. If it is still negative, I will change the rate. Oh, wow. At 8%, this is positive. That is enough for me now. This is enough for me now to get the answer of what is NPV. This is what I need. What do we need to find the trial and error? Step 1. Do trial and error. Step 2. Apply the formula. What is lower rate here? 12 and 8. 8 is a lower rate. What is my lower rate NPV? Minus 108 positive. What is my higher rate? 12. What is my higher rate NPV? Minus 97. That's it. Step 1, do the trial and error and find one positive NPV and one negative NPV. That is what I did. 12% they asked me to do. It was negative, so I did at 8%. You can do it at 7%, 9%, whatever you want. Do trial and error. If it is still positive, get a higher rate. If it is still negative, get a lower rate. and so on. So accordingly, you just need to do the trial and error, apply any formula. If nothing is given, randomly take 10% and 15%. See, check if one is positive and one is negative. Note, try another rate. You just need two tables ready. At one, NPV has to be positive. At another, NPV has to be negative. That's it. That is how it works. Are you getting my point, guys? Then apply the formula. I'm taking you back to the formula. This is my formula. Here, my lower rate is 8. My lower rate NPV is positive 108. 108 minus 97. My higher rate is 12. Lower rate is 8. Just need to solve this equation to get the NPV. This minus minus will become plus. 205. And this will be 4. 108 multiplied by 4. 432 divided by 205. 108 multiplied by 4 divided by 205, which is 2.10, is equal to 10.10. So ideally 10.10 should be my IRR. That's it. So I can always screenshot this and paste it here. Too big enough. Yeah. So as per formula, my IRR is 1.10. There is no need to cross check and examine it. That will be the final answer. A fraction of difference will be there, but that is acceptable. So if I calculate the NPV at 10.10 or say simply 10%, what do I get? Slightly near to 0. 2 is all fine. 2 or say 0. Fine, all fine. That small difference is okay. If I ever do make it at a 10.10, I guess I will get exactly 0. Don't try it again, unnecessarily wasting the time serves no purpose. So this is how I get the answer to question of IRR. Yeah, meanwhile, don't forget to visit the MEPL website, which is www.meplclasses.com. Go to the courses, go to the international courses. In categories, select ACCA. All the subject of ACCA for all the levels are listed here. You can always enroll yourself. A heavy discount is currently going on. Go enroll yourself and take a maximum benefit. Even my classes are listed here. A combo is there, subject wise classes you can take. All the options are available for you. My ACCA advanced financial management classes are available at only 21,240, which was earlier 30,400. It's almost a one third of discount, 33% of discount. Don't forget to take a maximum advantage of this opportunity, guys. So here we find the internal rate of approach. Now, how to comment on that? That is also important. So comment is that if investors required a rate of return, or that is all nothing but a cost of capital, is less than 10%, accept the proposal. If investor required rate of return or cost of capital is more than 10%, do not accept the proposal, because NPV will be negative anyways. And if investors required rate of return or cost of capital is equal to 10%, indifferent, it means जो करना है करो भाई, करना है तो करो, नहीं करना है तो मत करो. 10% तो मिल ही रहा है, एनपीवी जीरो भी है तो मतलब 10% रिटर्न एग्जैक्टली मिल रहा है, उससे ज्यादा नहीं मिलेगा, नॉट अ पेनी अबाउट 10%. So this is how IRR works. Interpretation of IRR is what I explained to you. Go through it. Very, very important. Very, very important. I will rate it as a 5-star category of concept. Every ACCA student must be able to answer this question perfectly in an examination, also in an interview, in case if you are going to face the interview in future. Now we have a little advanced concept of this called as a modified IRR, modified internal rate of return. What is this? First, let's calculate it, okay? Then I will tell you the answer also. All right, guys. So here, question says, a project with the following cash flows under consideration. In T0 means time 0 means 0 year, 20,000 will go out. First year 8,000 will come, second year 12,000 will come, third year 4,000 will come, and fourth year 2,000 will come. You are required to calculate the MIRR, modified internal rate of return. How do we do that? So let's first understand the concept of IRR, and vis a vis we will try to understand the meaning of a MIRR. So this is the same question. Year 0, 20,000 will go out, 8,000, 12,000, 4,000 and 2,000 will come in. So let's see, cost of capital is 8%. We will calculate first IRR and then we will try and understand the concept of modified internal rate of return also. How does it work? So if 8% is given, just calculate the NPV at 8%. It will come positive. If you want, I can show you with the same cash flow. No problem. It won't take me much time. Illustration 4 on MIR. So 0 year 20,000 is going out, minus 20,000, and then 8, 12, 4, 2. 8,000, 12,000, 4,000 and 2,000 is coming in. Cost of capital is 8%. The formula will change to 100 divided by 108. That's it. And if you see, my NPV is positive 2341. That is what you can see listed here. NPV at 8% is positive 2340. Now, if it is positive, I want a negative cash flow. I can use a higher rate. So 10%, 12%, I don't know. Don't want to do much trial and error. So I'm straight away jumping at 15%. Okay. 100 divided by 115. So I get a negative cash flow. So I have two rates. One is a 15% where NPV is negative, and one is a 10% where NPV is positive. That is enough for me to calculate the IRR, no? So this is what. So IRR is lower rate plus lower rate NPV divided by lower rate NPV minus higher rate NPV multiplied by lower rate higher rate. If I solve the formula, I get IRR of 14.46. What does that mean? It means that at any rate below 14.46, NPV will always be positive. So if anybody want to earn 10%, 12%, 13%, 14%, say then this project is for you. Put your money here, you will be in a benefit. But if someone wants more than 14.46%, say 15%, 16%, 17, 18, 20%, tell them this project is not for you. This project will not earn more than 14.46% for you. This is as simple as it is. So this is the concept of a IRR. But what? How we say that this project earn 14.46% maximum? Assume you have to put 20,000 today. At the end of first year, you will receive 8,000, but you will not withdraw it from the business. You will keep it in a business. For second year, 12,000 will be income, cash flow, but you will not take it home. You will keep it in a business only. 4,000 you will earn in a third year, but you will not withdraw it. And 2,000 you will earn in a fourth year, but you will not withdraw it. Assuming that all the money invested today, earn in a first, third, fourth year, all kept in a business and all withdraw at the end of a fourth year, then your annualized return will be 14.46%. This is the concept behind IRR. But now, so read the explanation carefully. What you can see on your screen. If IRR is 14.46%, it means we assume that this project will earn the return of 14.46%, but it is true only if we earn 8,000 in year one, and it is not withdraw in year one, but reinvested for year 2, 3, and 4 again. So everything you earn, you keep it in a business only and do not touch any earning, do not withdraw any earning for the 4 years. Same 12,000 second year you earn, keep it in a business. Everything you get to withdraw at the end of fourth year, but not before that. This way, if you keep your money in a business, it will give you the 14.46%. But now if you go to someone and try to convince him, sir, give us a 20,000 today. Your profit will be 8,000, 12,000, 4,000, 2,000, and your IRR will be 14.46%. He said, I was expecting only 12%. This is good scheme for me. Take my money, invest, do whatever you want to do. And after 1 year, he will call you, give me my 8,000. And you'll be like, no, sir, no. I meant we will earn, but we will not give you. You will get everything at the end of fourth year, and you will be like, oh God, You just make a fool out of me because I was not so good in a finance concepts. You fooled me. I'm I'm totally disgusted with what you have to say. This is not what I was expecting. You made me wait for 4 years. But if someone knows that IRR, see, NPV is not so good. If you tell someone, sir, NPV is positive, give you some money, not a correct way to communicate, particularly to them who understand the finance. They will be like, your NPV is positive at 8%, but I want a 12% return. I'm not going to give you the money only because you are saying that NPV is positive. Then we come up with the concept of IRR. We tell them, okay, sir, IRR is 11.5%. Your expectation is 10. Give us the money. Then he will be convinced. But again, IRR is also not a so good concept because you don't get to withdraw that money from the business if the life of a project is 4 years. So 4 year you have to keep your money for 4 years. 10 years, so you'll have to keep your money for 10 years. 15 years project, you'll have to keep your money for 15 years. And people may not be agree to this. Then they come up with the new concept. They said, don't tell me NPV is positive. Don't tell me the IRR. Tell me the modified IRR. Now, what is modified IRR? Very interesting concept or lost concept of a day. And then we will end of this lecture. We'll meet again tomorrow for the next lecture. What is MIRR? So first, let's understand the concept. Formula. Formula is MIRR plus 1 is equal to present value of inflow divided by present value of outflow raised to power 1 by n. N means the life of a project multiplied by 1 plus r, your required rate of return. So what do we need to calculate the MIRR? Four things. Cost of capital, which is given in a question. Present value of inflow at given cost of capital, which we know already. Present value of outflow at a given cost of capital, we know it already. And life of a project, we know it already. So as for calculation of IRR, we need four things. For calculation of MIRR, we need four things. Formula is MIRR, modified internal rate of return plus 1 is equal to present value of inflow divided by present value of outflow raised to power 1 by n multiplied by 1 plus r. If you put the values here, MIRR plus 1 is equal to 22,340 divided by 20,000 raised to power 1 by 4 because the life of a project is 4 years multiplied by 1 plus 0.08, sorry, which is my required rate of return, 8% or 0.08. And if you solve this, you will get MIRR as 11% only. It means what? When the cash flows are given in foreign currency, okay, forget it. So this is the formula to calculate the MIRR. Here it is assumed that if you invest 20,000 today, earn and withdraw 8,000, earn and withdraw 12,000, earn and withdraw 4,000, earn and withdraw 2,000, then maximum you can get is 11%. So even if the IRR of this project is 14% and someone is expecting 13% return, he will not be in a good shape to invest in your project, because if he want to withdraw the money, he will only get 11% return. So if anybody want less than 11% and want to withdraw the money quickly as soon as it is earned each year, then modified internal rate of return will be 11%. So this is the concept of MIRR. And this is a note. In a computer-based exam, you can use MIRR spreadsheet function to save the time here. So you can use the formulas also. You can use the specially formulated MIRR sheets also. Okay. IRR also you can use the direct formula, see IRR of this cash flow. is 14%. It is so easy to use the Excel. You can also use MIRR of this cash flow. 7%. And I'm not sure how to use the MIRR rate, but you can use this, okay? CBS training, you'll have to take separately. IRR you can use. So going ahead, there is an alternative method of calculating the IRR. The same formula used differently, nothing else. Then we have the payback period and discounted payback period. We will start with this topic tomorrow now. Then we have the duration, Macaulay duration. Then we have the topics on capital rationing, multi-period capital rationing. I will get you through all the illustrations. Meanwhile, whatever questions are solve the test your understanding question, read the theory carefully for the first and second chapter. And maybe tomorrow we will be able to finish up this unit and start a fresh unit. So guys, this was for a day from my side. Thank you so much for being there. See you tomorrow again. Keep enjoying your lectures at MEPL, one of the best teaching institute for ACCA in India. Bye bye. Have a good day.